Hi, and welcome back to the Personal Finance course. I'm Tom Mihawk, and we're in section 3 of 3 talking about real estate and other alternatives. And we just talked about private equity, and now we're going to talk about venture capital. Venture capital is a very common, fairly well known, not necessarily to not necessarily to everyone who doesn't invest in them, but everyone hears about venture capital. It is considered a type of private equity. It invests early in company development. Well-known venture capital funded companies include Google, Facebook, Apple, Uber, Twitter, Genentech. You know these names. Probably many companies that received initial funding. It's become a very professional investment marketplace. Many companies receive early funding from what are called angel investors, and even before that, maybe from friends and family. Those are called seed rounds, then angel investors, and then professional venture capital investors come in investing in various rounds. Today, those are called Series A, Series B, Series C, and they describe how big they are, what return expectations are, how much equity the venture capital firm expects to get, that sort of thing. Good returns for venture capital investors would be 20% roughly or greater. In a portfolio, you generally hear that if you have 10 investments, you would hear that 3 or 4 might do fairly well. 3 or 4 might only return their capital, if that, and 2, maybe 1, 2, or 3 would be big hits, unicorns as they're called today. And if your venture capital portfolio can produce more than that out of 10, that's great. But that's often what people talk about in terms of a typical investment portfolio. Fees generally high in the same 2 and 20 fee structure I described before. And venture capital is generally for accredited investors. As I've been saying through this chapter, these kinds of investments are becoming more available to a broader range of investors, but not yet, not completely yet. And so they're still generally available for people that make individuals $200,000 or more, or couples that make $300,000 or more, and some other requirements that beyond just those summary requirements. Hedge funds are pooled entities that are unregulated and have wide latitude in what they invest in. Everyone's heard of hedge funds, right? 20 years ago, let's say, early 2000s, they were booming. Anyone who had invested in any capacity professionally was a potential possible hedge fund manager. That's changed, and there's a lot of talk about whether hedge funds are continuing to generate alpha. Remember, alpha is a measure of that amount that the return is greater than the expected return. And hedge funds historically have been very good at generating alpha, but in the last few years, 3, 5, it's been harder for them to do, and there's a lot of question about why that is. They tend to have low correlation to traditional market indices, which is, again, true of most alternative investments. Typical strategies include equity long short, where you're both long and short different securities, or maybe the same, but different securities so that you can produce a return in a wide variety of markets. Global macro, where you're investing in a wide range of global securities like currencies and stocks and things like that. Event driven, meaning investing in companies that are doing exceptionally well, or distressed companies that are doing exceptionally poorly. Credit or fixed income, debt investments. Relative value, meaning low cost relative to some index maybe, or relative to its competitors. Commodity and managed futures. These are typical investment strategies of hedge funds. Fees are typically high, just like the previous two, venture capital and private equity, 2 and 20, same. And they're generally for accredited investors. Again, they're becoming more available for a wider range of investors, but they're generally designed for accredited investors. Now, real assets. Real assets include real estate. We spent a lot of time at the beginning of this chapter talking about real estate, but you would include real estate in real assets. It also includes commodities, metals like gold, silver, and industrial metals, natural resources such as oil and gas, raw land, timber. Direct investments in items have value based on their substance itself and on their physical properties, like gold. Gold is beautiful. It's very heavy relative to its size, and it has intrinsic value. Gemstones. People have always said, people have invested in gemstones for eternity because if you were nomadic and had to move from one place to another, you could put all of your net worth in a leather pouch, put it in your pocket or tie it to your horse and drive to the next location you were going to set up your camp, and you could travel with your net worth that way. That's one reason why gemstones are so valuable, because there's a lot of value in a very small area. They too provide uncorrelated returns to typical securities, so they offer diversification. They tend to be more stable but less liquid than financial assets. They tend to hold their value because they have intrinsic value. Now it changes over time, but they tend to be less liquid, more stable but less liquid. You've got to find someone you can sell a gold bar to or diamonds to or something like that. They have proven to be effective hedges against inflation. People want to own real assets when inflation is going up because they go up too. And real assets have proven to be an effective hedge against inflation. Return expectations can vary from 5%. You might be happy to get 5% return with a security design, to be an inflation protection device. And others will offer maybe 20% or greater depending on the asset class within real assets. So here's a photo of a gold bar. Look at that. It's beautiful. And frankly, so is the silver next to it too. I've never held one, but I've been told by investors in gold bars that they're very heavy relative to their size. So they protect against inflation. They have intrinsic value. The gold bar, unlike say a paper dollar, which is representative of $1, a gold bar is what it is. It's intrinsically gold, in this case 1,000 grams of very pure gold. Gold is a better investment for most, has large liquid market driven mostly by investment and jewelry demand. There's a lot of trading activity, large market for gold. Silver is much less expensive, and so silver might be a benefit, a good investment for many people because it's less costly. And by the way, it comes in ingots. Those are those little. There's a silver bar at the bottom there in the middle photo. Ingots are these smaller bars, and then coins, of course, which are arrayed around them. So collectibles include coins, and not gold or silver coins as in the last slide, but historically significant coins. Memorabilia, like collections, automobiles. You see those shows on TV all the time where they sell old renovated automobiles. Gemstones, artwork, furniture and antiques, paintings and other kinds of works of art. In this market, you need to be a pro. You need to be an expert at what you're collecting. It really benefits you if you have a personal interest in these items. I wouldn't buy automobiles. Number one, you would want to look and make sure you're buying an automobile that's rare and that goes up in value if you're buying as an investment. But if you also bought it because you liked to collect it, that has merit too. And that brings us to our next point. Accumulating valuable items for collection purposes because you like them or you're interested in those items versus purely as an investment. You should compare the two. A former client of mine, Ray H., was collected huge, these 10 foot by 10 foot, some weren't that large, but one of President Buchanan was, paintings of presidents. And he told me when I visited him in Palm Beach, he said, Tom, one large painting like this is valuable, but a collection is more valuable. And so he was trying to collect a great number of these so they could sell them as a group. You should know that there's a market for sale for your collection. If you want to own 20 10 by 10 portraits of presidents, great. Ray H. had these all in a warehouse that he owned in Palm Beach. He didn't have them in his home, and he was collecting them there because they were safe. I'm sure it's because they were in a humidity-controlled environment, but because he wanted to resell them, and he could, photograph them there and that sort of thing. So you really need to be a pro with your collectibles. So let's wrap up. Why invest in alternatives? Summarizing for all of these, uncorrelated performance to traditional securities provides diversification, giving you a chance for greater returns at one level of risk or lower risk for the same return. Diversification is vitally important in building a safe and valuable portfolio. The potential exists for higher returns than traditional securities. If we think in stocks we're going to get an 8 or 10% return, let's say, and we're looking in venture capital or private equity for maybe 20% in that range. Now, they're not guaranteed, they're riskier returns, but the potential exists, and with good selection, you can find those kinds of returns. Fees tend to be higher, and you want to look at the net return, not the gross, but the net after your fees. Now it's increasingly possible to access these kinds of investments than ever before, and my sense is that that will continue, that the breadth of people, the net worth level is lowering for people who have access to these kinds of investments. At one time, these investments were only available to pensions, foundations, institutions, those kinds of investors. These investments can be less liquid than more common investments like stocks and bonds. Expertise is not only helpful, but probably necessary. Know your investments. Prepare in advance. Learn about the potential returns and the risks. If you're going to invest in real estate, not as in your home, but I mean as an investor, start networking. Start reading blogs and podcasts and talking to people, learning about real estate professionals and knowing contractors who can do work effectively, cost efficiently, and on time. If you want to invest in private equity or venture capital, read, learn, talk to people. And of course, you may have to reach a certain net worth range, not only one to qualify, but number two, to have it be valuable for you as an investment. But become an expert. And if not, invest a tiny bit to get started so that you can learn more about how to invest in real estate and other alternatives. This has been the chapter in the personal finance course on real estate and other alternatives. I'm Tom Mihawk. You can find me at tommihawk.com. You can find me at my YouTube channel. Please look me up, and I look forward to seeing you at our next chapter soon.